Okay, in this video we're going to have a look at the second major type of investment that's relevant to the Unite course of investing, and your other option for part one of your savings and investment assignment, which is bonds. So I'll run through what a bond is, noting that this isn't covered in your textbook, but it's a really key, relatively conservative type of investment that's important to understand. So I'll go through what a bond is in general, and then we'll have a look at government bonds in particular. Okay, so firstly, a bond is a fixed income instrument. So that means fixed income, meaning that generally the rate of interest that this particular investment pays, kind of like a term deposit, doesn't change, i.e. it's fixed. And it represents a loan, as highlighted in yellow, a loan made by an investor to a borrower. And often that investor is a mum or dad, so it's someone like you or I or your parents, and then it's lent to a borrower, and that borrower is often the government, or it's a corporate, so a big business here in Australia, or it could be a global big business. So a bond, otherwise thought of as an IOU in terms of you're lending someone money to a government or a corporation, and they owe it back to you at some time in the future, depending upon how long this bond has been issued for. And it's an IOU between the lender and the borrower, as I've just described, and that particular bond includes the details of the loan and its payment, so it's articulated on that particular sheet of paper. Historically, those sheets of papers were actually physical sheets of papers that were given to the lender. These days, however, it's just that those papers don't exist, although they may exist in a soft copy form, i.e. that it's something that can be emailed, PDF or the like. Bonds are generally issued by companies, so corporations, BHP, National Australia Bank, ANZ, Google, those big corporations may well issue bonds in an effort to raise debt finance. They can be issued by state governments, and they can be issued by federal governments as well. So, New South Wales government issues bonds, the Australian government issues bonds, and I'll show you an example of that a little bit later. So the owner of the bonds is the debt holder or the creditor. So, for example, at the moment, Virgin, the airline, has gone into voluntary administration. Virgin does have some corporate bonds that have been issued. So they've borrowed money from mum and dad investors by issuing bonds. And those mum and dads have bought those bonds for a period of time. At the moment, those issuers of those bonds, so the mum and dads who have bought those bonds, they have become a creditor to Virgin, because at the moment there's not a guarantee that those bonds will be repaid to Virgin. So that's what that means by credit. You become a creditor, or you are a creditor as soon as you've lent that money to that business, and you, in the event of a wind-up of that business or a bankruptcy of that business, you hope to receive that money back in full, but sometimes that's not the case. Some additional details, and these are the things in bold and yellow are the really key facets of a bond. So the fact that a bond has a date to maturity. So they're issued for a certain length of time, known as the maturity date. That can be 5 years, 10 years, even 30-year bonds. A key detail of a bond is its yield. What's it paying? 5% yield, for example, means it's paying 5% of whatever the value of the bond that was issued at the start. And normally a bond is issued in $100 face values. So they're worth $100. You're lending to Virgin, or you're lending to the Australian government $100. And if the yield's 5%, that means in return they'll give you $5 every year. They have a coupon payment. That $5 I just spoke about is the coupon payment. How much are you going to get every year in return for lending the money to this corporation or to this government? They have a term. So that term is often, as I said, 10 years, i.e. how long is it issued for? And they have a face value. The face value I referred to before, often $100 or $1,000. $100 is quite common. Just one technical piece, I suppose, that bonds have an inverse relationship. The bond price has an inverse correlation with interest rates. So, for example, when the rate goes up, the bond price generally falls. The bond price will fall. And when the rate falls, the price of that bond goes up. And we can talk about that more in class and answer questions about that in class. I've already spoken about maturity. And the important thing is that maturity. So, for example, the government bond we're going to have a look at shortly that has a maturity date of 2032. So, in the year 2032, the Australian government, in that instance, is going to give you back your $100 that you bought that bond for back in. These ones were issued in January of this year, 2020. Now, if the government defaults, that means they're not going to pay you back your money. Now, they wouldn't want to do that because it's going to have all sorts of implications for them. But that is one risk of owning a bond, is that government defaults on that $100 and you don't get it back. Go back to the global financial crisis. The Greek government and the Turkish government, I think, defaulted on some of their debt, and they didn't pay it back to the people who lent it to them years before, and that had all sorts of implications for them. It meant the next time they wanted to issue a bond, the investors wanted to get a much, much higher rate of interest because it was perceived they were a very risky government to lend money to. Okay, so government bonds. This is just to give you a bit of understanding about bonds in Australia, and at what time, and the level of bond issuance. Sorry, so the blue is representing bond issuance. So in terms of dollar value, what's the dollar value of bonds that have been issued historically? If we go right back to the early 80s and right up until about 2008, you can see those blue bars are quite low, and that means the Australian government was only issuing roughly $50 to $100 billion of debt. But that started to really increase as the global financial crisis hit. The government needed to provide some stimulus to the economy, and to do that, they needed money. How are they going to get money? Well, issuing government bonds. So going to investors, not necessarily Australians either, by the way, could issue these globally and saying, hey, we need to borrow some money. Who wants to buy it? These are the terms. And you can see that the amount of debt taken on by the government through the issuance of government bonds has increased quite dramatically over the last 10 years. Okay, as I've sort of made the point already, let's focus on government bonds specifically. So when you invest in a government bond and you go and buy that government bond for $100, you are lending money to the government at an agreed interest rate and for a certain period of time. In return, the government is promising to pay you interest at regular intervals, so normally twice a year, so what they call a semi-annual coupon, and they're going to repay your loan at maturity, so give you $100 back or give you $1,000 back at maturity. That's an example of what a bond would have looked like way back many years ago, when they were a physical piece of paper that were actually given to you as the investor. And you can see these ones had face values of $1,000. They were issued by the Commonwealth Government of Australia. They were for 15 years. You can see in sort of blurry writing down the middle, 15 years, 4%. I think that says 4.5%. Sorry, a 4.5% bond. And the government was looking to raise $25 million through this particular issue. We've spoken about credit ratings and credit ratings of individuals in particular, but credit ratings of governments in terms of issuing government bonds is extremely important. AAA is the highest credit rating, and then credit ratings go all the way down to D, which is effectively getting towards junk bond status, and that means that so let's go back to the top. Sorry. So AAA is referring to governments that are perceived to be very risk-free. Effectively, you lend money to that government. It's a 99.9% chance you want to get your money back, and they've got a AAA rating because historically they've been excellent at paying back their debt. The perception is the country is very well governed, so the economy in that country is very well governed. There's no issues, there's no likelihood of irregularities from a fundamental perspective in how that economy is run. And Australia falls under that category, by the way. We are AAA rated. And then as the rating falls to AA, A, triple B, for example, the yield that those governments need to offer on the bonds that they're issuing goes up. So Australia can issue debt because we're AAA rated at quite low rates of interest, whereas a country that's, for example, BB+, they're going to have to offer a higher interest rate to compensate the investor for the perception that there's a greater risk of lending money to that particular country, to that particular government. Okay, so what might a government bond look like? I'm just going to jump here to this particular treasury bond. Okay, so these bonds, and I chose these ones because this particular tranche of bonds, so that means a tranche is a number of bonds that were issued, and these were issued recently, 22nd of January 2020. They were issued in Australian dollars. They were issued by the Commonwealth of Australia, i.e. the federal government. They are going to mature on the 21st of May 2032. They have been issued, their coupon, they have been issued at 1.25% per annum, which is hardly anything. And that's the reason I chose a relatively recent one, to show you how low a rate of interest the government is having to pay to borrow this money from bondholders. 1.25% per annum paid semi-annually. So that means twice a year you're going to receive a small payment, which in total is going to be 1.25% of the face value of these bonds. And it doesn't actually say, but I'm assuming the face value on these is $1,000. They're going to redeem them at par. So par is the amount of money they're issued at the start. So if they're $1,000, that's what you're going to get them back. That's what you're going to get back for, assuming you hold this through to maturity. I should make that point that bonds do have a secondary market. These bonds could be these bonds could be sold in the secondary market to someone else at either $100 or above par value or below par, depending upon what the market is doing. The coupon payment dates have been made clear. You receive a coupon on the 21st of May every year and the 21st of November every year. And the first one will be made on the 21st of May 2020. So in fact, in about 10 days' time. Here we go. Okay, $1,000 face value for the Treasury bonds and $100 face value for the exchange traded Treasury bonds. So this sheet is actually for an exchange traded Treasury bond. That means you're trading on the ASX. Whereas if you're buying them physically from the government, they're in $1,000 face values. I'm not 100% sure why they do it that way. I think probably because the $100 ETFs, exchange traded funds, are sort of easier amount to trade in. Okay, and that's the sort of deal with those ones. So you're going to get a payment every 6 months until maturity. At maturity, you hope the government is saying they'll pay you back your $1,000, and you can, if you want, trade them in the secondary market. And that is really bonds in a nutshell. I can certainly answer any questions in class coming up.